This may come as no surprise to some of you, but large corporations are crushing small businesses right now. Not only that, but they're actually doing much better than the US government itself. This chart that you're taking a look at is the net interest being paid by non-financial corporations. You can see it was fairly consistent all the way from 2007 all the way to 2021. And then starting in 2022, it just fell off a cliff. Now, we know that corporations in the United States are extremely overleveraged. They have tons of debt. So why is it that their net interest payments are going down? Especially considering that over that same time frame, interest rates have been increasing. You would expect that during a time when interest rates have been going up, that corporations would start having to pay more on their debt, and their net interest payments would not be decreasing. But in fact, that's what we find. So why is this? Well, during 2020 and 2021, debt was extremely cheap, close to 0% interest rates, especially for large major players like big corporations. These companies correctly predicted that those easy money times would not last forever. And so they refinanced a ton of their debt and borrowed a little bit extra, loading up on that extremely cheap debt. But it's what they're doing with all that money right now that's making all the difference. Corporations, like always, are invested in things like US government treasuries. And as those bonds have continued to increase in what they're paying, that means corporations are receiving larger and larger interest rates on the debt that they're invested in. Very simply, they've borrowed a lot of cheap debt, and then they use a lot of money to loan it back out at higher interest rates. And as interest rates have gone up over the last 2 years, it has made this trade more and more profitable, which means their net interest payments are now at a low point for the last 17 years. And the higher interest rates go, the more this will benefit corporations who, again, have locked in this really low interest rate debt and are able to loan out that cash and get a higher return. This is just one of many ways that central planning and intervention using monetary policy to try and control economic outcomes in a nation usually benefits the largest players over the smaller players. When times are easy, that easy financing goes mostly to the big players. And then when times get tough, it's them who are able to withstand those tough times and benefit from the higher prices. Neither one of these conditions, artificially easy monetary policy or artificially tight monetary policy, are an argument that is sufficient to say, hey, we should be doing the other one. In reality, they're both an argument saying, hey, we should be doing no intervention at all. This is evidenced by the fact that small businesses right now do not have the same position as large businesses. This chart was posted by Charlie Bilello on Twitter, and it shows the smallest 50% of the companies in the S&P 1500 are paying way higher interest rates right now than even the middle 40% and definitely more than the largest 10%. Essentially, the largest corporations were able to lock in the cheapest and the longest fixed rate debt, and the smallest companies were not able to do so. It is much more difficult for small, unknown companies to borrow in public markets, let alone smaller companies that have to borrow privately, than it is for larger corporations that can issue bonds publicly, regardless of their fundamentals, regardless of their financials. And no, this was not the case prior to 1970, showing that it is not a result of free markets or late stage capitalism. This is simply a result of the fiat monetary system and the central planning and intervention we have today. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my my link in the description below, you will get $100 worth of Bitcoin just for signing up. The difference in net interest payments is one of the reasons leading to the underperformance of small businesses in the United States right now. This chart is the IWM to SPY ratio, which is a measure of the performance of the Russell 2000, which is small businesses, versus the S&P 500, which is large businesses. When this chart is increasing, that means that small companies are doing better than the large companies. And when this chart is decreasing, it means the big companies are outperforming the small ones. And unfortunately, it looks like this trend could continue for even longer. Now, this fixed rate debt that large corporations have is not locked in forever, and in fact, it will have to get rolled over at some point in the future. But they've got plenty of time to prepare for this, and the higher interest rates get between now and then, more money they can squeeze out of this trade until it's done. Now, I mentioned that corporations, especially large ones, are doing even better financially speaking than the US government is right now. One of the ways that we can see the market is pricing that in is by looking at the yield on corporate bonds versus treasuries. Investment grade bonds right now are right around 5.5%. Now, 5.5% for investment grade bonds is definitely a lot more than it was just a couple of years ago, and it's higher than it's been for many years before that. But investment grade bonds from corporations do not have really any premium over the risk-free rate, which is lending money to the US government, which you can do right now for 1 year at 5.4%. Now, a government has a monopoly on violence, which means if push comes to shove, if they need to collect money to pay back their creditors, they can always use force. Corporations do not have this capability. Have you ever heard a news story about Amazon rounding people up and putting them in jail until they sign up for Prime? No, but that definitely happens when people don't pay their taxes, which means that typically you're going to see a premium on corporate debt because if they want to collect income, they have to create something that other people want badly enough to pay them for it and enough to do that to pay off their debt. Whereas with a government, all they have to do is say, pay us or else, which means that the government's debt is typically viewed as less risky, which means investors are willing to take a lower yield. But that's really not happening right now, which means that the market is really not looking at corporate debt as having that much more risk than US government debt, which all things considered is pretty big, since one can use force to collect income and the other one cannot. Recently, a lot of pain has been showing up in government debt markets, and one example is treasuries going sub 50 cents. Normally, when sovereign debt trades at 50 cents on the dollar, it means that investors think the borrower might default. Yet this is exactly what has happened to US treasuries over the last couple of years, with the price falling over 40% from the top. If you had lent money to the US government during 2020 by buying a 10-year bond, you'd be locked into getting 0.6 or 0.7% on your money for the next 10 years, which means that right now you'd still be stuck in that thing for 7 more years getting 0.7% on your money. Investors today loaning their money to the government for the next 10 years can get 4.3% every year, which means that you have one of two very bad choices. You could either hold on to this thing for the next 7 years and collect your measly 0.7%, or you could sell this thing at a massive loss. You'd have to sell it at a low enough price where whoever buys it from you would be getting the same return that they could get by investing in debt on the open market from anybody else at 4.36% right now, which means that for many investors in long-term US government debt, if they have to sell it right now, they're taking a 30, 40, or close to a 50% loss. Taking a longer term view of yields on US debt right now, we can see the 10-year just breached its recent resistance level and is now at the highest level it's been since October of 2007. Based on this chart pattern, it would not be surprising to see the yield on the 10-year treasury move up much higher to even 5% or higher in the coming months. Considering you can currently get T-bills for 5.5% right now and only lock up your money for 17 weeks, it still seems preposterous to me that anybody is loaning money to the US government for longer than that, unless of course you expect that the Fed will step in very soon here and drop interest rates again. And only then does it make sense to invest in that longer term debt. But over the last 3 years, the one thing the Federal Reserve has done consistently is engage in tighter monetary policy than the market expected and stay tighter for much longer than the market expected. The market is still pricing in interest rate cuts, a pivot during 2024. And my expectation is that the Federal Reserve continues with its trend of staying tighter for longer than the market expects. And finally, if in your checking account right now, you're still sitting there at 0 or 0.1% interest on your cash, you are losing. You're number one, losing to inflation, and number one, you're taking on excess risk that you don't need. When you put your money in a bank, number one, you are not an owner of that money anymore. You are a creditor to the bank. You are a lender. It's just a fact that savers are lenders. So if you're interested in learning how to cut out the middleman so you can reduce that risk and at the same time increase your real return so you can beat inflation with your savings, I just dropped a brand new course called Cash Management Playbook. This is available automatically for no extra cost to all members of Heresy Financial University. This is in addition to all the other courses that I've published, including courses on portfolio allocation, advanced options strategies, bear market investing, and much, much more. As always, members of Heresy Financial University get access to every single course I've published and automatically get access to every single future course that I publish as well. If you're interested in signing up, link is in the description below. Thanks so much for watching. Have a great day.